Imagine the following. American government led by Democrats are dead set on winning the next elections in November 2024, which is why United States Secretary of Treasury Janet Yellen has colluded with Jerome Powell on engineering this so-called soft landing. Janet Yellen, having been where Jerome Powell is today, knows a thing or two about manipulating the markets. That is why you probably don't know that she is all year quietly performing the quantitative easing that is more than offsetting the quantitative tightening performed by the Fed. Now, imagine this preventing the US economy from falling into recession, keeping government bond yields artificially low, and propping the stock markets higher, even though history tells us the opposite should have happened. This and the summary of Wall Street forecast of the S&P 500 index for the year 2024 is what you will find in this video. The most prominent Wall Street banks traditionally issued the end-year forecast of S&P 500 index, including their thesis behind these forecasts. In this chart, you can see the current end-year S&P 500 forecasts from various investment banks. Please take this analysis with a grain of salt. These forecasts are more like an alchemy than science, since predicting stock markets is pretty much impossible. More important than actual point targets is their explanation behind that. So for instance, at JPMorgan Chase, they are pretty bearish, expecting the index to close the year near 4,200 points. Now, it is well known that Marko Kolanovic, the chief equity strategist at JPMorgan, has tilted towards bearishness. According to his team, next year will be marked with worsening macro environment, which will slow down consumer activity that was formerly forecasted for this year. Now, normally this should be true, but with government interventions, things may not evolve as you expect them to. I'll explain on this more in the second part of the video. Kolanovic and his team add by saying that current market valuations are too high, which apparently means that the potential correction may be deeper should the optimistic expectations not materialize. They also cite geopolitical risks as a potential issue maker in 2024. I agree with this. If push comes to shove in the Middle East, oil prices may skyrocket well over $100 per barrel, which would be very bad for economy and inflation. Morgan Stanley is conservative but less bearish than JPMorgan. According to them, S&P 500 will reach 4,500 points by the end of 2024. They expect that the dominance of Magnificent Seven stocks will not hold for entire 2024 and that investors should avoid this group of stocks that are currently substantially overpriced. I definitely agree with this one. Morgan Stanley also recommends defensive stocks with high growth, which includes healthcare, utilities, consumer staples, industrials, and energy stocks. These are end-of-cycle stocks, which perform better when the economy slows down and rates are higher. They also expect S&P 500 earnings to grow at 7% next year. And now I have more optimistic players, such as Goldman Sachs, that predicts S&P 500 will reach 5,100 points at the end of the next year. The chart shows forecast of 4,700, which they have increased after recent rally. At Goldman's, they observe all the necessary ingredients for the soft landing. They observe the strong economic activity, falling inflation, and estimate interest rates will fall more and earlier than expected in 2024. They expect that earlier start to rate cuts in March 2024 would be a welcome sign for smaller and weaker balance sheet stocks, which is what we see in recent rally. Take for example ARK Innovation ETF, which grew 56% in recent months. Earnings are forecasted to grow at 8 to 10% according to Goldman, and they point out that in the absence of recession, earnings usually do not fall. Also, Bank of America supports this thesis of at least 100 basis point cuts in the Fed funds rates next year, with similar year-end target of 5,100 for the index. So it seems that most of the investment banks are optimistic about the next year. The S&P 500 is expected to grow up to the average of 5,000 points, which is not much of a growth from the current levels, where S&P 500 sits at approximately 4,700 points. Earnings are supposed to grow at 7 to 10%, inflation is expected to fall, and recession should be avoided. Interesting point to bear in mind is that stock market's gains will likely not be led by Magnificent Seven anymore. but by less overvalued smaller growth companies and perhaps by more defensive late cycle stocks such as healthcare or industrial companies. Current market consensus is very optimistic and expects only the best outcomes in 2024. But beware of these market expectations. There's something about consensus expectations often going wrong. For example, at the end of the last year, 2022, investors and Wall Street thought recession has been a done deal. Yet the opposite happened. The year before, in December 2021, markets thought that big tech would be immune to rate increases. But as you may know, stock markets were let down during 2022 precisely by the big tech companies. Now, this December, markets believe, again with absolute conviction, that the economy is heading for a soft landing, low inflation, and lower interest rates. Given the track record, being in the crowd seems like a pretty dangerous place since it so often turns to be a bad decision. Market expectations shape the economy and asset prices to a certain degree, and if certain scenario is fully priced in, then they may tend to decrease the likelihood of that scenario actually occurring. From the beginning of this year, I have been very cautious in my approach to the American stock markets. The reason is that many reliable historical indicators pointed to the economic slowdown and eventual unfolding of recession in the USA. Well, that was not only me, but most of the Wall Street expected economic downturn in 2023, which is why the average expectation was that index S&P 500 would fall as low as 3,500 points and close at nearby 4,100 points. As you know, neither of these things really happened. Recession isn't even remotely there, and S&P 500 fared much better than expected, closing this year near 4,800 points. Now, here's the thing. US economy should have fallen into recession. The aggressive rate of monetary tightening should have caused big problems in the economy, and it actually almost did so in March of 2023, when Silicon Valley Bank and other regional banks bankrupted. But guess what? The US government and the Fed intervened. They have printed hundreds of billions of dollars to save the banking sector, and it worked. Fundamental historical analysis tells us that US economy should have been in recession, but these analyses are useless, unfortunately, if government and the Fed are significantly manipulating the markets by secretly adding the liquidity into the system and stimulating the economy, as this chart shows. This is why this year was extremely confusing, even for some of the best informed macroeconomic investors. And let me tell you, as long as the US government continues to intervene with the natural market forces, the stocks will remain highly unpredictable and unhealthy. Economic recessions are a natural part of economic cycles, and it is a healthy cleaning mechanism that lays ground for the next phase of healthy economic expansion. Currently, this mechanism is being forcefully suppressed, which is not good for the markets nor for the economy in the long run. Think about it. US government is throwing money at the economy even though it is expanding. GDP grew at a rate of 5% in third quarter and unemployment is at record lows. This money, moreover, is not for free. It is taken from the future of American people. Have you seen a movie, The Gladiator, with Russell Crowe? In that movie, Commodus, the son of Marcus Aurelius, murders his father to become Caesar of the Roman Empire. But due to his low popularity, he starts depleting the grain reserves that were intended for future consumption to afford the gladiator games that entertained the populace of Rome.
He neglects even the most fundamental task of government. So just what is he planning?
And what pays for it? These daily games are costing a fortune, yet we have no new taxes.
The future pays for it. He started selling the grain reserves.
This can't be true.
He's selling Rome's reserves of grain. The people will be starving in 2 years. I hope they're enjoying the games because soon enough they'll be dead because of them.
Caesar Commodus is a prime example of populist politician who doesn't mind sacrificing the future well-being of the state for his career benefits. A very short-sighted policy, but that is exactly what I think a US government is currently doing. Democrats know that presidential and congressional elections are nearing in November 2024, and that should the economic recession hit before these elections, the probability of them being re-elected would be significantly lower. Don't take just my word for it. Look at the data. For example, most of the newly created employment positions recently were government positions, so not private sector employments. And almost $2 trillion was borrowed by the US government this year only, which really speaks for itself. Should this logic be correct and Republicans will continue to tolerate this populist policy, there is high probability that recession will be avoided even in 2024. This time also the Fed will come to help by lowering the interest rates, just as Jerome Powell communicated recently. In this scenario, I think the US economy may be artificially held above trend growth in the next year. However, inflation problem may resurface again due to all of the economic stimulation. Stock markets will probably be more volatile due to the artificial dynamics powering the economy currently, even though it was really headed for a restart. If the economy remains strong, I expect the stock markets can grow a bit further in spite of unattractive valuations. But let me emphasize, this does not sound like a healthy natural growth. While medium term this may boost economic activity and stocks, in the long term this may lead to deeply negative outcomes. The government is trying to stimulate its way out of the current cycle, but all they are really doing is just probably prolonging this cycle and kicking the can down the road, where recession will still hit the economy in the future, and even more so because of all the artificial stuff. So putting on my tinfoil hat, it seems to me the US government, Democratic Party, is dead set on winning the next elections. They will spend as much money as they can to avoid recession and appease the populace. Janet Yellen, the current Democratic Secretary of Treasury, served as chair of the Federal Reserve from 2014 till 2018. She may have colluded with Jerome Powell and the Fed on engineering the so-called soft landing. Since she was once where Jerome Powell is, she knows various tricks and performs the so-called stealth quantitative easing with the Fed. This stimulates the economy and stocks throughout all of the 2023. This will probably continue in 2024 also. So far, this little experiment of theirs seems to be very successful and without consequences. I would be cautious, however, as this cannot ultimately remain without any consequences. The US financial markets are being strongly manipulated, which disrupts natural processes. Where all of this leads, I do not know, but I will be closely watching this experiment. And if you want to stay informed, well, make sure to subscribe to the channel for future updates. Thank you, and I wish you a Happy New Year 2024.